Well, good morning, everybody. I so glad it's Friday. Um, I just checked some of the markets. It looks like the interest rates are continuing to move around like yesterday, and that's going to be a fun trade. Hopefully, I've got my short bonds and short-term interest rates positions just where I want them. I got um, stuck in my long Italian uh, bonds that are crushing me today, but I think I'm short just about everything else. Oh, I'm long some the uptrends in some of the uh, corporate bonds and tips and emerging market bonds. So there's not everything is going lower. Um, I enjoyed the Derek's Clubhouse yesterday. It was fun. I even enjoyed the first topic. I mean, I don't know. I thought it was okay. I thought it was good. Didn't get a chance to chime in, but I would just say that I don't trust my experience and what I've sort of seen in the past and patterns, etc. So I have very happy to admit that I default to just following my system and not relying upon my experience. Um, but if anybody wants to pick up on some of those topics that you guys talked about yesterday, I jotted some of them down because I'm still confused on some of these things that Richard and Derek and the Brunos talk about the compounding. I don't think I really fully understand all this about compounding. Path dependency, darn, I certainly don't. I look at the trade stats and I don't understand fully the path dependency. Um, and then I was intrigued by this copying other traders' research and the problems with that. And I thought that was an interesting topic. But anyways, the any topic you guys are interested in, we can talk about anything. I don't really have much of an agenda other than what I've already mentioned.
G'day, Jerry. G'day, everyone. Yes, it was an interesting discussion with Derek yesterday. Look, one of the points was in relation to this research that Ole Peters did, and just to explain it, he talked about how economics, when we're dealing with the growth of wealth over time, it's non-ergodic. Now, what he means is this. So I'll give you an example of a gambling game. So the gambling game goes like this. You start out, let's say, with $100,000. In the next throw of the gamble, if you win 50% of that initial $100,000 outlay. So you win $50,000 and your equity goes up to $150,000. If you lose only 40% of that initial equity. So you lose $40,000 and your equity goes down to $60,000. Now, this is assuming a 50-50 probability of winning and losing. So, effectively, let's apply this to a coin toss experiment. 50% win, 50% loss. If you win, you get 50% of your prior equity. If you lose 40% of your prior equity. Now, when we rationally in our brain think of that relationship of the 50% win and the 40% loss, we assume in terms of expectation that that's a good bet. We assume that on average, we're going to have a slight edge with that betting system. And if we applied that to that fixed sum of $100,000, we'd assume that that $100,000 would rise over time. But this is where Ole Peters comes in with the crunch. None of the sequences that are performed using that over 1,000 trials actually produces positive expectancy. They all deteriorate and deteriorate down to zero very quickly, quite quickly. We might have a number of them taking off with positive trajectories, but they all decline. So this sort of flies in the face of what we think in terms of probability of winning and probability of losing when we're dealing with a finite sum and we're applying a multiplicative process to that finite sum. And this is where compounding comes in. And to understand that, we can understand that if we have a bet, if we compound an investment, and we have a 10% growth in that investment to 110%. On the converse, if we lose 10% and goes down to 90%, you can see when you look into that there's actually an asymmetry there, because when you're at 90%, it doesn't take a 10% increase to get you up to 100%. That only gets you up to 99%. And the converse is true from the upside. There's this asymmetry created. And this is actually the important thing in terms of compounding. So I'll give you another example. If we lose 50% of an investment, we don't have to catch up by a 50% increase once that occurs. We've actually got to catch up with a 100% increase on that reduced finite equity, which is now 50% lower. So this is what this compounding trick, this illusion of compounding does, and why it's so important for wealth building with our investment models, where we are reinvesting capital back into our trading system. We recognize that if there is it has to be a strong beneficial asymmetry in that underlying non-compounded equity curve to defeat what we saw in the Ole Peters experiment. We need a greater asymmetry in that underlying uncompounded equity curve to actually receive this compounding benefit over the long term. And that's where trend following really comes to the solution, because when you look at trend following models, the equity curves produced on an uncompounded basis versus the convergent models, when you look at their uncompounded equity curves, when you look at the geometry of those uncompounded equity curves, you realize that there's a greater asymmetry in the trend following models, because when we catch these non-linear outliers, they pay many times over the small linear losses that we've incurred along the way. And that asymmetry in that relationship, when we cut losses short and let profits run, is what is required to get this huge benefit and this huge lift over time from compounding. So that's that Ole Peters experiment, and why compounding is so important to the investment process, and why trend following does it so well.
Perfect. I mean, I think I can even I can understand all of that. Now, I have one question for you. Even though your trading and my trading are trend following and asymmetrical, we go maybe a step further, and we do not have to make 100% if we're down 50%, because we don't handle our equity that way. We continue to make the same dollar bet all the time, regardless of if we're down a bit or up a lot. We're always risking this 50 basis points of our equity based upon a sort of a static trade level. And so if we have 10 losing trades in a row, all we need to do is have 10 winning trades in a row, since we traded them the same size, all 20 trades, to get back to break even. Now, so maybe with our asymmetric trend following, we don't even need to do that, but we do it anyways because we're super conservative. And I do it that way, and you don't quite do it that way, but I will keep my trade level and my dollar risk per market the same for long periods of time. So that is exactly how I do it. If I have 10 losing trades in a row, all I need to do is have 10 winning trades in a row to get back. I am adding and subtracting, not multiplying. And now one could say, but you're putting yourself in a situation where if you're down 5 or 10%, that may work well. But what if you're down 20 and 30%? You're trading a bit large for your reduced capital and your reduced what should be your new trade level, which should take that 20 or 30% haircut.
Hi, Jerry. Hi, everyone. Just to, I'll just comment that, yeah, when you are slow to update your trading size, you turn the game, just like you said, from a multiplicative game into an additive game, and that additive game is ergodic. It doesn't have this property of leading you to ruin so fast, just like the coin game Richard just said. The problem with that is that if you don't update at all, you don't let compounding work for you, because when you suppose you start with $10,000 and you size your bets, your trades, to lose at most $100, and then after some time you have earned some winning trades. They in a larger amount than your losing trades, and then you find yourself with not $10,000 anymore, but with 100,000. At that point, trades that risk you losing $100, they don't mean nothing at all, and you should update your size, your sizing, the sizing of your trades, to benefit from the larger from the larger account you have now. So back to my point, if you don't update your equity size to influence the dimension of your trades, you're not letting compounding work for you. But on the other hand, if you update too quickly, then ergodicity bites you, from where I see.
Good day, good morning to everyone. I want to say such a point of my point that maybe it's okay to update this when I did it in a drawdown. So I have certain level of drawdown and update my size in this. Maybe it's a good point.
I just wanted to add one thing, Jerry, and that is when you say that if you lose 10 trades, all you have to do is to make 10 trades winning trades. I'm not sure that that's accurate. You could win it all back in one trade. I guess it depends on whether you're winning at least as much as you're losing on each trade. So it's not just a number of trades, it's actually also how much do you win on the trades, whether it's one trade or 10 trades. I don't think we can say in advance. That's what we need.
And sorry, another point to compound that is the fact that Jerry, in your and obviously the classical trend following way, there's this dichotomy between open and closed equity, which I think further complicates this problem. And if instead you look at your equity as one pool of money, or your capital, depending on whether it's realized or unrealized, you actually get to modulate your positions, and you can see, for example, what you could do, and the guys have suggested, you can compound only the losses but not your gains, in order to avoid what Ole Peters finds in his game. Your equity grows so large that your drawdown, however much it is in his game, is this 40%, sort of wipes out a big chunk of a very large equity curve. You can avoid that by having a slightly asymmetric loss function. And but again, I don't know how to adjust all this logic and all these tools and all these formulae to this precise environment that you're describing, where you're keeping certain profits in one bucket and certain others in another one, and so you're trying to defend this other bucket, but you don't really care about the big bucket number one. So yeah, I think there's added complication there that comes from this accounting system.
Interestingly, Bruno, just to add to Ole Peter's experiment, I started testing a few changes to those variables in that game, and what I found was very interesting. For instance, I started adjusting the probability of a win and a probability of loss. In that game, we had a 50-50 win or loss scenario in terms of probability, but our reward was effectively 50% and our loss was 40%. So what I started doing was I started to compare and contrast changes in the probability of a win, where I'd increase the win rate and reduce or alter the reward to risk relationship. And what I found was very interesting. I found that if the relationship between the probability of a win and the reward to risk relationship in the expectancy equation is not linear. In other words, it is preferable to go to a higher reward to risk relationship as it is to increase your win rate. So that makes me clearly start seeing how Paul Mulvaney does his trick with his compounding and why he gets these very long-term, strong, wealth returns, even though he's very volatile and has this large drawdown signature. There's this sufficient asymmetry, which is capitalizing on this non-linearity in the reward to risk relationship. In other words, his average win to his average loss might be, a 1 to 3 relationship as opposed to a 1 to 2 relationship. And he's getting that non-linearity, which is driving that compounded wealth in the long term. I just thought that was interesting.
Yeah, this was a point I was trying to make last week, is that should we sort of trade suboptimally as it relates to the trade stats? In other words, have a trade stop loss that is doesn't test out as well as some of the other a two ATR stop loss versus a 5 ATR stop loss in order to do what Paul is doing. And then Niels, you're right. I was very sloppy when I was giving that example of the 10 losing trades and 10 winning trades. Yeah, I messed up on that one. Sorry. But anyways, I was interested if Richard could comment on my question, which is, or my comment that in doing this, keeping the trade level or keeping the trades the same for long periods of time, and then, as Bruno said, you got to eventually, it's kind of like the way Richard does it is I think he uses the closed trade equity or realized capital and realized profits, and so his trades, if he's exiting trades, his trade level is changing a little bit all the time, and so he's not taking the same dollar risk or dollar trade like I am for long periods of time. So, and the problem with my method, of course, is that at some point in time I got to bite the bullet, and so yeah, all of the last 50 trades are the same size, but then what about the next 50? They're going to look much different size-wise than a lot of those first 50 that I still have on. Some of those I still have on. So I'm going to bite the bullet here soon when my open trade equity is low, discretionary call like, okay, my open trade equity now is low. I've gotten out of my grains, metals, energy, or whatever. When is this going to occur? And then I'm going to say, okay, this is more of a real trade level now that's going to keep me out of trouble. But the discrepancy between the old trades and the new trades is much greater than, let's say, for instance, the way Richard does it. And of course, another way of doing it is I could just say, like right now, I'm going to book a lot of that profit. Don't just make this huge call sometime next year to massively increase your trade level. Increase it a bit now. Like if you think you're going to increase it by 30% next year, go ahead and increase your new trades by 15% now. That's another way I've thought about doing as well. Like, let's keep putting this decision off. Um, and then I don't get confused by this at all. It's very simple. And keeping my trade level separate from my open trade profit is easy, and I don't have any trouble doing that.
The way I would think about it, Jerry, actually, in just what you spoke about, is if you don't spread out your increase, for example, of your equity, you end up having another kind of risk, which is kind of a timing risk. So I think it makes sense actually to think about it, saying, okay, if you're, and I'm just using some examples, if you know you need to increase it by 20%, then why not do it over 4 steps of 5%, and then you're there, and you kind of you lower your timing risk of the actual increase. That's how I would think about it.
I like that, Niels. Look, Jerry, in relation to what I do, so yes, I use the realised balance as opposed to the floating equity as a basis to compound. So I apply a trade risk percentage to my realised balance, which is a more subdued measure of adopting compounding into my trading scenarios. So the way I see it is that compounding is like diversification, another free lunch. So if we can utilize the principles of compounding, why wouldn't you do it? But where I'm concerned is that if we assume that our volatility is the same as it has been in the past, then we are likely to compound a story that finds that if the future is different, and our drawdowns tend to always be in the future, our worst drawdowns, that ultimately means with the impact of compounding, your volatility is going to be more extreme in the future. So I always adopt a principle that recognizing that the drawdowns or the maximum drawdown you're ever going to experience is always somewhere out there in the future. I always adopt a more conservative posture to how I compound, but I must do it because it is this free lunch, but I don't do it aggressively. If you do it too aggressively, I think that you can find that the leverage in the end might, make you experience these drawdowns that are so intolerable for investors that they'll probably pull a pin on you. And certainly as a trader, it's going to be a pretty harrowing experience under leverage, getting some of these massive drawdowns in the possible future.
The way I think about it is that it's a spectrum. The compounding isn't free. It comes at a cost, and the cost is that you have this path dependency risk, and that you might take a drawdown or start to lose trades on the bigger trades that you've just put on or that you have right after you've done it. And that kind of touches on Neil's point. We are in control of the leverage that we have. We can adjust the speed at which we want to capture that compounding. So if you do it in a slower method, you'll have a slower lead on, which will allow you to kind of adjust over time, as opposed to doing it in big steps. But if you do it in a big step and you're in a drawdown, then necessarily you have smaller losses there because you're able to defend that line. So if you just think of it as a trade-off like that, then I think it allows you to pick which speed you would like to move at.
I think as far as superior, these are small problems to have. I'm running into this big, huge problem when I'm making lots of money. Okay, I think that's kind of a problem uh, I'll figure out how to deal with it. I think it's far superior to using the capital, which is I think what most CTAs probably do. They use today's capital, total equity, and they use that as their sort of trade level. The word trade level doesn't really exist probably in their. They don't have that as a term. It's just the assets AUM right today, and then we'll use that to size our trade. And I think that it's safer to not use today's equity necessarily. And then there's a big penalty for um, you're introducing more randomness by and you're clouding your edge in your system by always trading the trades. All trades are basically traded at a different size.
I like that, Jerry. So, when our actual trades are underway, we don't touch them. We let them play out their course. But there's this thing called realized balance. It stays at a particular point in time for a period of time until those current active trades play themselves out in the course of the game. So, at that point in time, every single trade in your portfolio applies the same position risk treatment based on a percentage of, say, your realized balance. So I find, for instance, I might have months elapsing where my realized balance stays constant and my trade sizes are all consistently applied without any change to that realized balance until some of those home runs start coming in and lifting up that equity curve. But at that point in time, we know that we have received our profits. It's not a case of, um, compromising letting those profits run. It's a case of these are known profits now that have closed out. They now reside in our residual equity or our residual balance. They are no longer something that we don't want to touch. And now, with that sort of improvement in our equity position, we're ready to take our next risk gamble.
Hey, I have a question here. It's hardly you will have all trades closed at the same time and you have no trades on when you can update your size, and then all trades up starting that point will have a different size. This will hardly occur. What will probably be the case is you have some trades still on and you decide to update your sizing, and the trades starting from there will be larger. But what would you do with the trades that are open yet? From where I see, I think this is increasing the risk in or the risk allocation in trades that are still developing, that may well be all in the about to give back, and I wouldn't increase the trades that are already on. But what is your opinion?
Oh well, I am humble with this whole idea. I don't love my way. I feel like I'm give myself an A plus for pointing out the problems and it's difficult to come up with the perfect solution. However, on this question, I think I'm pretty convinced that the answer is no true up. You don't true up. Um, we used to trade when we got into this, we did this back test. And then one of the things the back test will say, in using my method, it'll say, well, you're trading long term, and that just really complicates this whole process for me. And so you're going to have these trades on that are 2 or 3 years old, and you're under trading them. So the back test will say, if you want to make your 15% return, you're going to have to trade larger. So I mentioned that. So don't forget that that's kind of another thing that I do as well. I may trade larger than people who use the current day's AUM to size their trades for every trade and for every day, because I've got to trade a bit larger and there could be some issues there with the back test that it's giving you this advice and it's based upon historical performance and how things have turned out in the past. And yeah, I get that. I'm not that happy with that. But I used to change my trade level and incorporate the current AUM on January the 1st, which I kind of changed. That's probably not that bad of an idea. I did lots of research. It seemed to work just fine. And then, but then I would also like true up those old positions, which I think is a huge mistake. That trade was put on a year or two ago, or historically when it was put on, you entered with a certain AUM, certain trade size on that day with that entry, and leave that trade alone. I don't think that trade should be touched. I'm pretty convinced about that is correct, because once again, that is really introducing some problems with it's complicating your edge. You have this edge, you should make money, and you could lose money strictly because you with, especially like right now, with all these great positions on and our AUM at elevated levels from when we put on these great commodity trades. Boy, you true up those things on December 31st, you could have a small drawdown and wipe out all of last year's profits.
That's true, but what happens after you have a good string of profits? Let's say your Modernas, your lumber, Bitcoin, all come off at the same time, like or in whereby creating a situation that largely increases your closed equity. Now, if you're saying, okay, I'm not going to compound that, the next trades you're going to take, your 50%, the 50 basis points are based off of a much, much smaller equity level. So implicitly, as you said, you're under trading. So how do you reconcile, because this is quite interesting, how do you reconcile the fact that we're not in control of many things, but the last thing we control is the timing of our profits. And true, we have reporting cycles and things like that. So investors like to book profits in December rather than January and all of that. We'd rather do the opposite. But how does everything fit together in order to create what Derek was talking about, a narrative or a consistent story that you can go out and sell? Because this is where I'm struggling in trying to understand how you can separate equity buckets, and therefore that's why I'm so outspoken about doing using this sort of accounting, and I'm more kind of leaning towards a more harmonious way of booking and considering and allocating risk on a full integrated equity basis.
Oh, I don't understand the in the story part. I don't know. I'm not exactly sure how to answer that.
From my perspective, I think Bruno, we kind of come to the same conclusion, and of course, I do true up my positions in relation to the new equity level whenever that occurs. I do that at different stages of returns based from whatever the baseline is. So it's like a fixed amount of additional returns, say 5 to 10 to 15%, for example. And what I find is that what you're paying for in that is the the correlation diversification, because if you don't true up the other positions, then your diversified positions won't overcome potentially one of the new losses, and your portfolio will be unbalanced. So even though you think you have a diversified portfolio, some have more power than others just because they're allocated more than others, and that adds an effect of randomness. I don't want to have to depend on these new positions more than I do the old positions. And then going to Bruno C's point, like what happens if these old positions are good, the ones going to be stopped out? Well, um, they would have had the same probability to stop out whatever your position size. So that doesn't really affect me. And if they were closer to your stop loss because they had already been in drawdown, necessarily you would have lost less money than you would have if you just put them on today. So you still get whatever benefit that was going to happen, and we cannot have that path dependency. We cannot say that one trade is worth more than the other. So I find that truing them up and maintaining the full power of my diversification at the cost of these old potential positions um, to be worthwhile.
Oh, but then you have to update your stops as well, because suppose you're let's talk about those simple systems that we have: one entry, one exit, and one stop. And if in this example you're in the top P&L of this position, starting from now, it's all give back. If the size is equal all the time, then you'll expect that 50 basis points loss you would expect in your system when you designed it. However, if you size the position up at that point and you don't update your stop, then your loss is going to be potentially larger. So for this to work, for this truing up to work, you have to update your stop as well, correct?
No. The reason is because the basis points scale. So if you are risking 50 basis points and you increase the notional AUM that you're applying to it, whether that is realized or unrealized, the thing you are changing is the amount of contracts you put on. So you may put on more contracts at a random point in this trade's kind of life cycle, but the amount of risk will be scaled to that as if it was an original stop or what have you. So the stop position doesn't change, just how heavily loaded you are changes.
Yeah, I kind of agree with that. But this is a fascinating discussion because it gets back to just these two different worldviews, and it's gonna because and then all these issues that we may disagree about. I think a lot of them, if not all of them, revert right back to this one major monster issue, and that is: are you hunting outliers, or are you more concerned with, and how could you be even closely as concerned about anything other than hunting outliers, with sharp balance, diversification? It's the trade, the primacy of the trade. These classic Neanderthal trend followers are looking at this trade. That's all they care about. How to maximize this trade. I got it. I'm on it. I got to take this thing and see if it's going to go 500, 200, 1,000 ATRs. It's going to dominate my performance. I'm never going to scale it back. I'm only interested in crushing this trade and all my trades. And I know that I'm not even thinking about it, but out of the corner of my eye, I know, okay, someone in the accounting is going to sum up all these trades, produce a performance table that looks like it's crazy and volatile with rates of return all through it, daily, monthly, weekly, annually. But I'm not going to really focus on that. I'm just strictly head down, maximize this trade. It's all about each individual trade. And 5 or 10% of those trades are going to really matter. But I don't give a flip about sharp, balance, diversification, the performance table rate of return. I I care about how many ATRs did I make in some of these trades? Did I maximize it? Did I follow the system? It's the primacy of the trade without regard, really, not always or actually, but trying to theoretically not care too much about balance, diversification, sharp returns from the performance table, but just this trade.
Amen, Jerry.
Yeah, I mean that's it. This is really it. I mean, as you said it, you don't believe in a portfolio as an object of its own. For you, a portfolio is a collection of trades, and each trade needs to be managed the way you described. Other, portfolio theory and other methods, the ones that I follow more closely, for example, actually do care about the convexity in the portfolio, trying to actively manage this diversification with a lot of pitfalls. I'm not here to say that. I said it many times, but it's impossible to argue with people's success. But I'm not even saying that what I'm doing is superior to anything. It's got its own problems, but it kind of treats portfolios an independent object relative to the very same trades that compose it. And yeah, it opens up different dynamics and different problems. But you nailed it. I mean, this is the difference between classic trend following and other styles.
I remember getting into business, and I know when traded for Rich, I never heard about, and these were super smart guys, Bill Eckhart and Rich, and they were doing amazing research. They talked about research all the time. This was the 80s. They had computers. Bill's almost a PhD in math. And, listening to Bill talk about math is, you realize, he's really literally from another planet. And I never heard about Sharp. It was all about these trades. And then I get out into the real world, and then the Europeans invade and conquer CTA land. And I'm looking at this Sharp and drawdown. Well, vol targeting, and then the rate, and then returns. I was like, what returns? No, it's the trade. The non-normal distribution is you line up all your trades and convert them to ATR, profits and losses. But these guys are using rates of return. Where did this come from? So I think it's just all you smart people invading classic trend following and trying to have it both ways, and not turning your back on all of your knowledge and education, but understanding that this momentum and trend is pretty darn good. And us old timers are like, uh, no, you're messing it up, because you're creating a hurdle that we don't need to put in front of ourselves. We need to convince people that paying attention to these outlier trades and maximizing the profit, which means they're going to be very volatile, is a better road to go than saying to them, well, watch me add what I do to this trend following thing. We'll make it better, and we'll be on this eternal search for a higher Sharp and less volatility. And then it makes it difficult for all of us who are saying, no, 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 let's just hunt these outliers. It's pretty funny.
I think I want
I love
to
this.
take a different way to look at it, because all portfolios are built up of individual trades. I don't think that looking at the forest, so to say, you know, say you're a park ranger versus someone who's planting individual trees, maybe a gardener. I don't know. It's a bad analogy, um, because we're all going to target the same outcome. How we adjust our notional amount, because we're talking about the dollars, but when you change your trade level, you're still going to be risking your 25 or 50 basis points a trade. So if you looked at like the first time you did it, or say it's Jan 1, and then you update it again, in the summertime, on those days where you upgraded and you put on the new position and it was the bigger position, it would still be the same amount of basis points. So in returns land, it's basically the same. Um, but we have this feeling as humans, we are risking more money. We are making more money when we see that, daily tear sheet of all of our positions, and what's winning and what's losing. It has an emotional impact, more or less, on what that is. I I think we need to separate that part out, because in the end, if we're all trading a breakout strategy and we update our positions at different times, yes, that will create some return dispersion between fund managers, which we know occurs. But that doesn't preclude all of those fund managers from being trend followers. And so I think that this is a high class problem, because we are absolutely targeting these outliers. We are hunting for them. Um, just it's your perspective. And I think that they go together. If you are able to put on better, more bigger outlier catching trades, uh, both people would want to do that. And if you're the person who's focusing on the trade, you would want to know that your forest is robust and diversified, because that's also one of the main tenets. So if I take that perspective, zooming in and zooming out is just as important, because it's that we get benefit from both of those areas. Putting on good trades that make a lot of money more than they lose, and also having a diversified set of trades. And sometimes in this particular instance, when we need to increase our AUM or increase our notional dollar risk, but the same risk stays the same, that's a decision point that may cloud it, but in the end, you are still doing the same job, if that makes sense.
Oh yeah, I think it's just an obsession versus not being obsessed with these outliers and making that kind of the bottom line above anything else. I think to some degree, CTA diversified trend followers, they have more diversification. Well, I think I have more diversification than, and my goal would be to have more diversification than any other trader on the planet. But I don't really care about diversification nearly as much as I do getting these outliers. And as Richard clarified and got me straight a few months ago, and that's how it was taught, and I kind of lost sight of that. I remember sitting around thinking, my positions are out of whack. They're not balanced. I'm not as diversified as I could be. And I just remember, we had this diversification, but we didn't care about it or talk about it so much. And then Richard got me straight by saying, hey, we don't trade these markets for diversification reasons. I don't trade 130 markets and 50 commodity markets because of diversification. I like it. I'm happy about it. I'm thankful for it. I trade them because it increases my likelihood of getting an outlier. And I agree with him, if he still agrees with what he said before, which
Spot on,
is that
Jerry.
which is that I'll even make my portfolio less diversified by trading Brent and WTI the same size, because maybe Brent or WTI will have an outlier that the other one doesn't have. So I am on purpose going to just continue adding these markets only because of the outlier, and not fine tune my portfolio to make sure I don't have overlap, because WTI has a different name than Brent. Ipso facto, it can have an outlier when Brent doesn't.
I see it exactly the same way, Jerry. And look, I think in our trend following world, we're a peculiar beast because we're targeting these tails of the distribution of market returns, which are inherently unpredictable in nature. So the conventional logic of, for instance, using diversification as a way to manage risk in the portfolio, I think that's sort of like a nicety in our space, but it's not the reason we hunt these outliers, and it's not the reason we actually diversify. So, under the traditional sort of understanding of the benefits of diversification to smooth volatility, we say, well, they might say, well, there comes a time in your portfolio where you become diversified. And personally, I feel that is not a case for our trend following perspective when we're targeting these outliers. So what we're doing is we're saying we want to trade infrequently, but when the trades are material in nature, we want to be on board them. So that necessarily reduces our trade sample size per return stream. But what we're doing is we're saying, right, but now we need to increase the frequency of these catching these outliers. So we need to diversify, and as much as we possibly can. So that's our method, effectively, of increasing our win rate. It's a way that we turn a story of maybe 2% success in a single return stream to a 35, 45% win rate. It's through our extensive diversification. So I personally think that that is not valid for alternative methodologies that are not targeting these outliers. When you're targeting something that is predictable in nature, that is not unpredictable in nature like our outliers, diversification does become diversification, because the whole premise of a predictive outcome is that you need preciseness, you need accuracy in catching that predictable move. There's accuracy and preciseness associated with that statement. But diversification, of course, is more applied to the uncertainty principle when you don't know when these things are going to occur. We sacrifice preciseness for uncertainty by having many possible systems to mimic basically the nature of the market itself when it gets into these extreme situations. So, that's why I think when we're talking about trend following, we set ourselves apart and say there's an additional benefit for why we diversify so widely, and we never assume that we're too diversified. It's because that is actually a necessary outcome for targeting these tails of the market distribution of returns.
I actually think that pure diversification is a requirement for trend following. You can imagine a portfolio that has 100 stock indices and you try to trade trend following on it. You'll have all of the trends all at the same time, and you'll have all of them whipsaw all at the same time. You've changed your opportunity set. Yes, in a small sector, having 5 or 10 energies out of 150 is not that big of a deal, but necessarily you do need all of the different sectors because they're going to give you a different opportunity set at different times. Not only does that, as Richard said, increase your Sharpe ratio, which obviously in this group we don't care, but you want to be able to capture a trend all of the time. And if all of your trends are happening at the same time, okay, you might be able to make it. But having them rotate at different times is a much easier thing to do because then they also won't draw you down at the same time. So if you could imagine the reverse portfolio where you have 100 perfectly diversified markets, the trends will occur randomly, and over time that will kind of even out. And you will have a much smoother curve to do that. But that also means that you're going to have an equal opportunity to do that than if you had, 100 equity indices. So I do think at the limit, if we take it to the extreme examples, it is required in order to do any sort of trend following. I mean, another example could be you trade only tech single stock equities. That would be a super extreme example. They all move together, and your trends may kick off. It might take a while. They might go into drawdown for a while. It'll take some time for you to roll over. Um, I think that it's a different game.
Yeah, in other words, I'd say that if you don't diversify, you're not. It's similar to not trading small, because suppose you have identical markets, and you think you're diversifying, putting positions in these identical markets. What you have in the end is a huge position in a single risk factor, and you think you're diversified, but you're not. What you're doing is you're trading large in this single risk factor. Just like Derek said, if you go to the limit, suppose you have identical markets and perfectly independent markets. Ideally, we would be in the independent ones and let the identical markets aside. We get one representative of these groups of identical markets, and that's enough. But in real life, we have a spectrum of equal to completely independent, and we try to diversify between them.
Bruno said something interesting. This being all on one risk factor, and it's basically your leverage on the same thing, but it made me think of something else, which is that if you have all of these different trades or the same trades and living on this spectrum, correlation itself also has I wouldn't call it non-linearity in it. And this comes to the point that Jerry is saying, why can I have nat gas, crude, and Brent, but crude is breaking out or nat gas is breaking out in all of the energies? And it's because you can have a change in the correlation. It's like when that relationship breaks down, you're probably going to get some kind of outlier because it's acting non-normally, or say not in its normal state. And that is where trading multiple of the same things happens, is you're actually getting the benefit of these correlation breakdowns. So that why have it, I think that kind of reinforces what he's saying. But when we are trying to look for non-normal events, correlation breakdowns are probably going to be something that's good for you, and it in fact will increase your correlation because this thing is not doing what the sector is doing. And that is a different opportunity than someone who is only trading all of the same thing, where we were talking at the limit, and all of, say you're only trading fangs. That probability is quite low. It's possible, but the probability for these correlation breakdowns gets lower than if you have I mean, the commodity space is quite interesting for this. You have like tons of different kinds of wheat. You have like French milling wheat. You have Kansas City hard wheat. You have the standard U.S. wheat. But they're all kind of they all kind of move together, and then sometimes different things happen. And I think nat gas, European nat gas versus U.S. nat gas, is a great example of that. There are physical barriers um, that prevent physical arbitrage because shipping nat gas is extremely difficult. So that allows for persistent breakdowns in correlation when normally that's not happening. And we do catch that as a side effect.
Yeah, and that's great to get this opportunity to trade the different wheats that that are distributed in different regions, that come from different regions, that are traded in different currencies. All this is good because, just like you said, most of the time they trade similar side by side, but sometimes they one of them breaks loose, and that's when we want our system to be deployed and get the benefit of trading these supposedly similar instruments or markets, and get that outlier. But what I'm saying is that in my example is it it makes no sense to trade the CME corn and the CME mini corn, because these guys are identical. And if you think you're diversifying, you're not. You're just making a double bet on one single thing. That's Chicago corn. That's what I'm saying.
I totally get your point. As someone who stares at screens of a basket of 600 or so TMT names every day, they're not as correlated as you may think they are. You can look at Apple and Google this quarter; they had very divergent outcomes this week post earnings. So it's there is some correlation. I totally get what you're saying. CME corn, CME mini corn. I assume there's an extremely high level of correlation there, but it's less in the world of like TMT stocks, or if you're looking at particular industries, it's less than you may think it is. From a high level view. And then you got to take into consideration that the overlaying the system reduces that correlation. You get bounced out of the French bonds, oats, and then because it hit the breakout, but then oats and Boone rally, and so now you're flat or short oats, and now you're still long your Boones. Not that this has happened to me recently, of course, but there is a bit of benefit to some change of correlation, and yet those two markets remain 90% correlated, but now you're long one and short the other. So and then the P&L diversification, even on two markets that go up at the same time and enter on the same day, exit on the same day, but the ATR was different, and the correlation by traditional measurement continues to be very high, but one made 50 ATRs, one made 200 ATRs. So where does that fit in to your desire for diversification? And I think I remember one time many years ago, our company won some award. They have these awards that they give out, these magazines, and then they want you to go to New York, buy a table, and get your award. So somehow we got this award for like best sharp. And this was like so accidental, right? Because we're like, oh, we're never going to be here again because we don't even care about sharp. How did we get this award? It was totally by accident and, prior to our probably large drawdown. So it's not like we don't like, I would prefer to do everything correct and then, oops, you have a good sharp. I'm all for that. Don't get me wrong. It's just not my priority.
Yeah, look,
Well,
I think you've actively got to seek out measures that actively break correlations. So, a really simple example is, when you compare a long only portfolio to a long and short portfolio. So, whilst we recognise that our shorts might not actually be giving us, significant opportunities over time, it's a necessary factor to break correlations. And for instance, our choice of markets to trade, our choice of systems to trade, our use of things such as co-integration in our system design, our use of things such as changing the base denominator of the instrument we're trading, like when we're trading two different commodities, we change the base currency. All of these things disrupt this correlation to produce an uncorrelated portfolio. So they are necessary components in our search for outliers. We don't restrict our opportunity to find outliers in any market opportunity, but we use little devices that break these possible correlated relationships from adversely impacting our wealth story.
yeah, I was gonna say, because obviously we're talking about diversification in markets, but obviously there's also, as mentioned, diversification in systems and time frames. So there's different ways to uh, also break the correlation in that sense. So we can look at it from the different spectrums, and if we create a diversification in these different spectrums, then you get different outcomes, in my opinion.
Talking about the system diversification is really important. In fact, I look at our trading systems as a returns transforming machine. You put in the underlying, you get out something else. And this something else, if you even take two different parameterized trend following systems, let's say a short term and a long term, you get quite a lot of diversification, even looking at the same underlying. In my research, about difference of 0.15. So that, I think, it helps us allow our machine, even if you were to trade, something correlated. And I thank you, Avi, for correcting me on my example. Um, by having multiple systems, even if you're only trading one thing, you can turn that one thing into a portfolio of systems that are more diversified, even if you could only trade one underlying. And so then, if you do that with a diversified set of uh, assets that you're trading, then you squared your diversification. So I think that's something that's really to take into account when we talk about overloading our portfolios with a single sector, because, like Jerry said, they won't necessarily act the same, and then overlaying our systems on top of that, even if they had 0.9 correlation, you're going to drop them to 0.75, which is actually not bad. If you look at the energy sectors, for all of the different systems that you're putting on it.
That's right. This trend following systems, they transform these markets into hunting for outliers, into something that has a positive expectation. From theoretically, me believe that they all have the same expectation, and we no longer have to choose whether to include a market into a portfolio based upon its buy and hold, like they always are doing with, okay, so you can have stocks and bonds because buy and hold, they deserve to be in the portfolio, i.e., they've made money. Um, Bitcoin, not so much. Oh, yeah, now you can put Bitcoin in now because now historically it has done that, and gold probably as well. So now that whole dysfunctional portfolio of mostly stocks and bonds and other things being in and out is this remarkable, massively diversified portfolio of longs and shorts, thanks to this systematic approach.
Yeah, I like that, Jerry. One of the key things is that, when we compare ourselves to a buy and hold, let's say a 60-40 portfolio, they're relying on this correlation between equities and bonds, offering this tail protection, which we know is not necessarily the case over his history. It certainly has been valid over the last 20 or 30 years, but things might change. But where we set ourselves apart from them is that we use a system itself to constrain our adverse risk. So we cut losses short at all times through our stops and our trailing stops. So we're applying this extra level of defence, this risk defence, into our method than what this buy and hold approach does, which therefore allows us to be a bit more lenient on requirement to search for uncorrelated markets. So if, for instance, we invest all of our effort in looking for the impacts of correlation in a portfolio, I don't think that that's time well spent when we've already got a design in place with our systems that takes a large component of that risk away. So that therefore means we can loosen up a bit and be more active in hunting for these outliers than to, for instance, focus on diversification as a means to, balance our risk across the portfolio.
Yeah, I see those systems as like almost like translators. That's a good example, maybe. Or let's say different planes. Obviously, you have smaller planes that will be able to carry 10 people, but then you have the bigger planes that be able to carry maybe 300 people. So they will catch different elements of the price movements, because obviously we have limited information, which is high, open, close, and I'm missing something below. That's technically the limited information, but the way it's being interpreted will depend on the system. So obviously, depending on the parameters, it will catch different parts of that, maybe those four components. Obviously, if you add volume and all that kind of stuff, then you have more components. But just sticking strictly to price, it's just different ways to translate it. So obviously, if you go low time frame, then it will go in and out much quicker. But if you so it's just different ways to translate the same information in a way that the system signifies it as.
Hey guys, I've been thinking on we every now and then we talk about the trend following golden rules, and I've tried to write them down yesterday, and I'd like to share with you and see if I'm missing any. I've come to 5. The first one is do the trade. The second is trade small. The third is cut your losses. The fourth is let your profits run. And the fifth is test what you trade and trade what you test. Am I missing anything?
I think maybe it's very important to not miss the trade, do all the trades.
And don't forget diversification, Bruno. We need diversification with our method. So we can't, for instance, apply trend following to a single market. We don't get the outcome that we're wanting if we're not diversified. So I'd just add that extra golden rule, diversification. I reckon you've nailed it.
Also, for me, it's golden rule, proper risk management. A very,
Yeah.
very important risk management rules, very important. So that's my point.
Well, I think that now for some, diversifying, cutting losses short, a proper definition of a trade level, or some sort of reasonable trade level thing, that is our risk control. Oh yeah, and then I would add one of my major rules would be, you maybe hunt outliers. I think that deserves its own uh, line item. And then when all else fails, and especially for Jerry, who's doesn't have what I would consider to be heavy-handed, no sample size risk management of the portfolio, since I'm not doing that, at some point in time, I may run into trouble, and I may need to exercise this one big rule, which is to cut your positions in half or by a third and trade really small for a while, because you're having this big drawdown and your capital trade level real realize realized balance is low. And no, I've never, as I've mentioned before, to some degree, there historically, I don't think much money management is needed, because the drawdown in the capital account, in the realized capital, is always exceeded by the open profit. So if you're really trying to define capital the way I just did, then even a drawdown in that has, in the back test, is every single day has been exceeded by the open trade equity. And but now that may not always be the case. We got close, I think, in 2000 and I don't know, I forgot the year, 8, 9, 10, I forgot exactly, but and but anything can happen. So you do have to have that one overriding rule, especially, is to stay in the game, make a big cutback on current positions and future positions for a while.
You say take the trade. Should we make it take the rules-based trade, to sort of put it into the camp of systematic as opposed to discretionary? Just a thought.
No, yeah, that makes perfect sense. And actually, I've just added this first rule, this do the trade rule, because I was comparing. As I said to you guys a couple of weeks ago, I'm running a couple of back tests, comparing systems, comparing entries and exits, see what comes out. And just like Jerry has told us a long time ago, the longer term systems, they seem to perform better. But the problem with them is that I can only have a really, really loose exit rule if I have an equally loose entry rule. I don't know, if I'm exiting in the 300-day breakout, I have all this give back, I have a terrible hit rate, but the outliers are awesome. They have these systems have an excellent win-lose ratio. The problem with them is that I don't do many trades, because the entry has to be equally longer term. So that's why I added this do the trade rule. And I feel that it's antagonistic to the let your profits run rule, because I can only do many trades if I don't let my profits run too much. Well, just my view on this. If you would comment it, I would welcome it.
I definitely know where you're coming from, but in my world, I'd sort of probably have another golden rule, in that I do apply a filter for all my trades. So what I'm using is I'm using a filter, such as a look back, to avoid overtrading, avoid getting involved in the fairly normal average daily range of the market activity. So I'm using a filter to only get excited when the trends become material in nature. So that almost is a golden rule to me. Don't take every trend. Wait for the trends to become material in nature. But when you do get onto that trend, that's where my system diversification takes over, with short-term, medium-term, long-term models. So I don't class myself really as a long-term player, because I have systems that many different systems that are targeting different aspects of convexity in that outlier. So this filter is a way that I can avoid these rules, saying that, look, I should apply this at all times. I'm saying, well, actually, there are discrete moments in the trade distribution which are more eligible than others to apply our philosophy. So, that's just how I do that, Bruno.
And I want to ask. I'm sorry. I want to ask, say my opinion about the filter. So that I think that filter. I don't use this because I think that these filters can filter me out from a big trend. And Jerry said that, and Moritz, as I remember, said that, and I totally agree with this. I had research on the filters, and I didn't see the difference, at least, between trading with the filters and trading without filters. I didn't say it was a result of my research, but maybe. So here's my point. But I
So
think
Oleg, what I'm saying here is that when I'm using a 150-day look back or a 500-day look back, that is my filter. It's
Yeah, yeah.
excluding me from trading during normal market regimes, and it's actually the medium to long term look back, which I do apply. But when trades start getting activated, when that look back is reached, I've got short term models with fairly tight ATRs, medium term models with slightly wider ATRs, both in terms of initial stop and trailing stop, and I've got long term models which are very sort of loose with long initial stop ATRs and long trailing stop ATRs. The basis is that I'm staggering my implementation into an outlier with a vast array of different models to capture different trajectories, different aspects of that nonlinear feature, and potentially some of them last for a very long time. But I'm trying to get this greater convexity in my model by at least having sort of shorter term, medium term, and long term models applying when that look back is reached. That's all I'm saying. So when I say filter, I think we'd all agree we use these long look backs, but that to me is a type of filter.
I did the same. I did the same. So a few years ago, I did research, and of this, I traded in short term in a direction of a long-term trend. I did so, and I had this research. Maybe this research wasn't fully completed. Maybe it's not enough. I had not enough data, but I have found that drawdowns are the same. I have found this, and from later from Jerry and Maurice and Nils, I get known that you can filter out from a big trend. So I decided not to use filter at all, and I think it's better to use a massive diversification instead. It's my point. Maybe I'm wrong. I don't know, but it's my point.
So I think we're saying the same thing. So the actual rules become some form of filter now. If you're making the filters or the rules too complex, saying, "Hey, I got these trades," but then when the moon is down, I'm not going to trade it. Then you're adding another rule to it, so you're making it more complex. So that there's a balance between having too many rules, where the rules become, or the rules in itself, which would be the filters, will become too complex. And there is then also the main core part where you have the basic rules that is just fine and balanced. So I think we're saying the same thing, just the fact that the rules are the filters, but don't make it too complex that you're overriding those rules. So having too many not let you trade every trade, which would mean that it overcomplicates itself in that sense. I don't know if that makes sense.
That's right. I agree. I use breakouts, and I have had filters that would cause me to miss a trade. And so don't miss a trade, do the trade, follow the rules. Um, but definitely, if you're hunting these outliers, you cannot miss an outlier. We never miss these outliers. We're awesome at hunting them. We get them every single time, unless we have like you said, a bad idea, a complicated filter that's going to prevent us from losing 25 basis points. We have our head on backwards, where we're not paying attention to what's important, not the 25 basis point loss, nearly as much as taking the trade, but but holding on and following our rules. And our rules need to be good, and our rules need to not get us out too quickly. And what Bruno is seeing in this research is like, oh, this is amazing. These long-term systems are great. They don't do a lot of trades. It's critical to get on them. We're going to make a lot of money. And then that's when all the trouble starts, because we advocate for holding on and not paying attention to the volatility and the performance, but maximizing the profit, which is what these long-term systems do, but we don't really like it on a daily basis. This is like therapy to some degree. I'm telling everybody what I really believe in, but it's really hard to do.
I love the therapy part.
Let's hear from Seth and Boris, Andy, anybody who want to give everybody a chance to say a few words or give their opinions.
Yeah, just one note for me there. In all of my research and backtest, adding a filter in addition to the breakout criteria has produced significantly better results. Something as simple as, the 50-day moving average is above the 100, or, I don't know, an ROC filter, anything of that sort has produced better results.
Yes, I have a question. So, what is that? How much sample size? Because we can see a impressive results on a short term, maybe 1 year or 2 year, like Neil said, like in February 2018, for example. It's very important your sample size here.
Yeah, no, I understand. I back tested all the way back to the 70s, and it's also equally important to make sure that the data you're testing on, specifically futures, they meet a certain liquidity filter as well, because you can't include every single contract there for obvious data reasons. But from 1970s up until now, and I obviously welcome people to test it as well, but just apply something simple, 50 days above the 100-day, and compare it to what you would see with just a regular breakout. I think you'd be surprised to see the results. I think Andreas Klenau as well, he's done the same test, and I think he uses kind of something similar to that in his book. So definitely don't take my word for it, test it. Chances are I could have made a mistake somewhere, but that's just what my results have shown.
Boris, just to see if I get it clear, it's as if you have a double entry rule that both need to be triggered for you to enter the trade.
That's right.
Yeah.
So that's right. So essentially, what it is, it's trying to prevent you from being chopped up in the noise. I mean, it's nothing too over specialized or complicated. It's just basically saying if the 50 is above the 100, as an example, in a moving average, chances are that the market's in an uptrend, right? And then you would take any breakout that meets the criteria of whatever your X is, so 100-day, 50-day, 200-day, 300-day. What that does is it filters out some of the whipsaw trades that you would see, and kind of puts you in the right way of the market. I found that to be pretty simple and pretty effective. I know people that use other, ROC criteria, or I forgot what the other indicator is, like a MACD and stuff like that. But I just found simple moving averages in addition to the breakout filter to kind of filter out any of the whipsaw trades that you would get.
I hear you, Bruno, because when you're getting to that breakout level, there are different ways you can get to that level. If you're sort of creeping up to that level with no sort of momentum behind you, I often find that I just attach a small volatility-based filter or some momentum-based filter at that breakout to confirm that there is momentum associated with that push through the breakout. So yeah, I certainly hear where you're coming from, and I certainly do incorporate them into my models.
I agree with all of that. I think any sort of filter is going to be okay as long as it doesn't let you miss a trade. My overall philosophy, I mean, I look at the back test, I see what works the best. Especially, I'm willing to take some volatility and have the average trade be incredibly large. But I want to step back and say, well, what is going on here? And so my which is totally unnecessary. But one of my ideas would be that, well, what's going on here is I think the market, the back test is sort of saying to me, make it hard to get in. Make it hard to get in, not impossible, but there could be these wimpy breakouts. And so let's make it hard to get in. So maybe a good filter could help make the market make the breakout, close on its high, something like that. And then, but I never found that I needed that criteria for the exit. My exits were similarly long term, and we would start to test. Well, don't get out at the 100-day low, but let's say if we have to have something else plus the 100-day low. And like the back test was like, no, dude, get out. You have stayed in this trade so long. Take your money. You don't need any help. This exit is totally fine by itself. Get the heck out. Um, I do think that if you're trading shorter, what I would consider to be the shorter term entries, um, I think they're kind of suboptimal. So if you find that, well, I'll take the 50-day breakout, but I'll add something to it to make it not get into the 50-day breakout to where it more mimics the 150-day breakout, yeah, that those short-term signals entries, they need some help. They're too short-term, but improving the longer term breakouts with another filter is probably going to be more difficult.
And I just wonder if that's not the stairs up, elevator down. A lot of these moves, in my experience, are drastic, and you're not going to have like that MA crossover. In some of these world events that would really skew your results. That's my wonder.
Yeah, but these moves are more prevalent in the equity space. When you look at currencies or commodities, it's harder to. This asymmetry of the distribution of returns is not so clear cut as in the equity space.
Sorry, I want to say that one of the golden rules of trend following is to treat all markets, all sectors individually. Of course, you're right. Maybe that, of course, all markets, every market have its own things that can be only on this market. But our rule is to treat all the market individually, and I think it's a very wise rule.
That's good. Thanks.
Yeah, Bruno, I'd suggest for you to test with an applied filter. Like I said, it could be something very simple, like the 50-day moving average is above the 100 or the 100 is above the 200. It doesn't have to be complicated. The matter of fact is, if the breakout is valid, if the market is trending, it's going to get you in. You're not going to miss the trade. But what we will do is it's going to prevent the whipsaw action that we see kind of hammer traders. So give that a shot and see what you get. The other thing as well is, I'm not sure which software you're using or which data you're using, but I definitely recommend Norgate futures data, and then applying a liquidity filter to the actual futures market as well, because where I fooled myself is, I was including markets there that I typically wouldn't trade because they wouldn't meet my, liquidity criteria, or I wouldn't even have access to them. And it was giving me results that I wouldn't have had. So I'm not sure what it is that you're using, but just some tips that kind of fooled me for a while there, before I got that fixed.
Oh, I'm not only a Neanderthal trend follower, I'm also a punk Neanderthal trend follower. I prefer to do everything myself. I pull the contracts data, build my own trackers, and I've programmed everything, all my systems in Python, and well, it's all on me.
Nice. But when you say you pull the data, where are you pulling the data from?
Oh, from the usual vendors, Reuters, Bloomberg, these guys.
Okay, yeah, no, that's good, because I know some of the softwares that are available out there and the data that is not accurate. So it's very easy to fool yourself into thinking that what you're doing and what you're seeing is correct, but when you look into it, it's not. But it seems like you're doing all the right things, and I'm far from a programmer or a data scientist, but those are just some of the things that I learned the hard way. So it seems like you're on the right track.
Oh, thanks a lot.
Hey Jerry, it's probably a little bit late in in the conversation to bring this up now, but maybe this can be something we can focus on another week. You mentioned your golden rule of hunting outliers, and I'm curious what exactly that entails outside of what we've all kind of come to think of as the regular rules. And I think from kind of following your trading over the past few years, I think you actually have a few little tricks that are outside of the core trend following rules that help you hunt outliers. And maybe my request is maybe you just think about that a little bit, and maybe we can talk about that next time.
Yeah, that's good. That's a good thing to talk about. Gosh, I mean, I think I'm pretty. I don't know if I have any tricks up my sleeve. The only thing I'd like to be true, this is a little self-congratulatory, is that all these weird ideas I have, that this is what you get when you don't change your trade level very often and you just look at the trade. I think, once again, I give Richard credit and this group credit for refocusing me that it's just like I said earlier, the hunting the outliers to me means is that that's going to take precedent. I got bogged down in diversification, fine tuning my portfolio. Everybody gets, regardless of what you believe, we're bombarded daily. You're wrong if you don't think about Sharp. You're wrong if you don't care about total equity. I care about those things, but when I'm implementing my system and my rules, I'm saying to myself, is this what a person would do who's really getting the outliers their bottom line? And just a slight refocusing on that, because we all have these real world pressures from outside and from inside ourselves that we want to be liked and we want to have good performance, relative performance, and you can't hear every day of your life that Sharp matters, portfolio returns and volatility matters, without being influenced by it. But I'll give it some more thought. But I'm trying to think if I have I mean, I will say, like, just look at the big trades, look at those big trades and those big drawdowns, like Tesla. My system sat through that ridiculous Tesla. It sat through giving back a lot of profit in lumber. It's brutal. You're sacrificing, you're saying to yourself, this trade is really looking bad and I've really blown it, but I'm committed to trading all the trades the same way. So I screwed up a couple of big trades, but Tesla and Moderna made it all back. But then
So I'm glad that you mentioned those two, because those are the exact two that I was kind of thinking of. And when you say hunting outliers, that's different than executing on your day-to-day thing. And I think the difference is, when did you decide to start paying attention to Tesla and Moderna when you didn't before? And when you say hunting outliers, I think of that almost as, when is it time to start paying attention to a market that I haven't been paying attention to, that hasn't been included in my system in the past? And I think you're getting a little bit of alpha, call it, over the beta that normal trend following gives by being aware enough to start paying attention to something that you weren't paying attention to before.
very good. Yes, you're getting me. You're refocusing me on this question. That's good. Yeah, I got lucky on those, and this is not the first time I've said that. I put those markets in my portfolio for one reason, and that is when I compared, um, when I tried to find 25 stocks to put in my portfolio. Okay, parentheses, I'm not trading indices, so you got to put yourself in a likelihood of hitting a monster outlier. You've got to actually trade the market and be willing to trade single stocks in parentheses. I just put them in my portfolio because I ran a simple screen and tried to find 25 rather large equities that were not very correlated. And so I threw in Tesla and Moderna only because they weren't that correlated to the other markets. Now I have 25 or 30 stocks in my portfolio, but very few of them are going up, like the S&P, like setting records every day. I did an amazing job finding 30 stocks that are not that correlated. But it screwed me up because I'm not really making enough money being long the S&P like everyone else is. And so huge success, but it's not that great. Half of my stocks were kind of in downtrends. But I was lucky enough to get those two big ones. But then I added canola, rapeseed, palm oil, lots of other things that have gone. UK nat gas, strictly because it had these diversification qualities. But my portfolio is sort of permanent and it doesn't change. So I'm not out there hunting, which is going to be the next big move. I believe in a fixed portfolio and hope for the best. And given your fixed portfolio, that you'd prefer not to change ever, except adding more markets as they become available, then you just hunt them in that way. So it really is mostly um, not caring about drawdowns, volatility, as much as selling out totally to maximizing the P&L on a certain trade, on all your trades. And then I was going to say earlier that sacrificing lumber and sacrificing some of the other trades that looks like I mishandled because I was committed and then making all the money in some of the other trades, one could say, why don't you try to have it both ways? Figure out a way to still be in Tesla and Moderna, but have an alternative way of getting out of some lumber and some of these other markets that kind of crashed on you. And I think, that is tempting, but kind of not something I know how to do.
There's also another thing that I seem to be catching up by listening to you and how you describe your portfolio. You seem to have a unique knack or some sort of special attitude to catch on trends. And this is not, a play on words, but for example, these UK nat gas could have been luck, but I'm sure you heard chatter in the background about, problems in Europe. And, I'm sure you got lucky in Bitcoin, but definitely Bitcoin, it piqued your interest at some point and you got in. And we can continue. Uranium, you mentioned uranium, and that's very interesting because, there's a lot of talk about uranium being the next frontier and things like that. So maybe, I don't know if is something that you can verbalize or you want to verbalize, but it's definitely something special about you absorbing this information and very quickly thinking about, okay, what can I add to my portfolio? Not just for the sake of diversification, but to catch the next outlier.
Yeah, well, no, strictly it's just being obsessed with reading and researching. I look at the ETFs, I see what people are putting together as themes and making sure or trying to get that theme or that industry, that stock or company or commodity based market that could have a supply problem into my portfolio. And, just trying to add more. I used to be really concerned about diversification for more volatility reasons. Now I'm way more concerned about how do I get that potential outlier in my portfolio. And just being obsessed with that, um, I look lucky. And so, yeah, if you are obsessed with adding unique performance drivers to your portfolio, and then all you're doing is just applying these systems and buying these breakouts, You look like you're especially talented, and you're very maybe you're using outside ways to identify these things. But another thing that happens too is I added like 50 markets over the past year, and probably 40 of them I've lost money in. It's just the power of 500, 600, 1,000 ATR moves that you get, that it looks like you really know what you're doing.
Yeah, I think when we're talking about what an outlier is, I tend to look at it in terms of materiality, and I also tend to look at it as far as materiality across my universe. So that way, I am treating each market equally, but my decision to enter what I would regard as an outlier is based on the scale of its enormity. Effectively, when I can start seeing that something very unusual is happening. So that's where breakout models really help, because it helps draw that line in the sand to where you start wanting to participate in a market. And if that line in the sand for each market is treated as the same in terms of, say, some volatility normalization method such as ATR, then you can actually be very selective as to when you engage in a particular trend, and know that your method for corn is the same as your method for gold, is the same as your method for forex, is the same as your method for all of your different instruments. And that way we avoid therefore taking any trend. We're waiting for the trends to become so material that there is a good chance, you never know, but there is a good chance there is serial correlation in that trend, and there is a good chance that that trend is actually causing a change in participant behavior. Short traders getting squeezed, long traders getting squeezed. The materiality is so significant over the track record. So when I look at these markets and I look at my tests and I compare what are these actual events I get involved in, I only might have 3, 4, 5 events in a 40-year history for one particular market, and the same for the rest of my portfolio. So it's being very selective as to when to engage, because there is the inevitable cost of poor decisions with the whipsaws that deteriorate from that impact on the non-linearity of the other outlier when you get it wrong. So it's a case of being selective, but with a rules-based process that ensures that once that decision is made, you're in, based on the materiality of the trend at that particular point in time.
I'll be the biggest advocate for rules, but I'm just afraid when I hear people talk about their rules, they're rules, but they're not good rules, and they are allowing people to scratch an itch that they shouldn't be scratching, getting out of trades too quickly, avoiding trades, and they're not treating every trade the same way. So how many trades have you done recently that were not part of the one entry, one exit, and a stop loss? Well, I just felt like I should scale back on something. Okay, well then that's not a rule. That's a rule I have. I scale back. Well, it's not one entry, one exit, and a stop loss. So I don't like it. So if I'm correct, which I may not be, but if I'm correct, am I going to be surprised that performance is not as good because I have rules that are tempting me to do trades that are not core system trades, which is one entry, one exit, breakout entry, breakout exit, and a stop loss? Of course, I'm not going to be surprised, because that's the whole premise of treating all trades the same and having a robust approach. And um, so, but a lot of the rules, people just say it's a rule. Slap that rule sticker on it. I'm untouchable. Well, it's a rule. Well, okay. Yeah, it's a rule, all right. but you're not treating all the trades the same way.
Yes, but I think the rules must be based on the golden rules of a trend following, on the base of a trend following, or the structure of trend following philosophy, or in fact, on trend following philosophy.
Agreed. The rules all unite to ensure that we're trading with the greatest asymmetry that we can actually achieve, beneficial asymmetry. Those rules, provided we do treat those rules the same way for every market, those rules are specifically deployed to create asymmetry in our path, which generates these magnificent returns over time.
I think that if we have maybe even stupid rule, like if I see a cloud in my window in the morning, I will buy the stocks, and if I will not see clouds, I will sell. I think it will be better than discretionary way. But of course, we must have rule as good as possible. Of course, there is maybe no perfect way, but as I said a few minutes ago, our rules must be based on a trend following philosophy, and it's very important, extremely important.
Oh, I just thought of something. Let's come up with a list of seemingly reasonable trading ideas, and that we don't think is it's the bad list. Um, yeah, so we've got our good list going, which I'm continuing to add to. Um, but let's come up with our list of things that it's when people say them, they're not shot down. They're almost universally accepted in sort of the trend following systematic way of doing things. But I'll start that list. We'll do it next. I'll come up with that list for next week.
Can you include retracement entry into trend in one of those bad rules?
Yeah, buying dips. But I guess when I thought about one, it was this idea. Oh yeah, that everyone knows that if the trend doesn't take off quickly, you can just get out, like a day's thing. If you bought the breakout and it's not going anywhere after 5 days or whatever, 15 days, uh, everyone knows you can just get out, and that's fine. And so that would be my number one. I hate that idea. It's not good. It violates most of these ideas for me are just going to violate one entry, one exit, and a stop loss.
Have an example of a better rule? If so, it's a take profit. Do take profits. Don't let the profit run. And very better rule, I think. Not it's against trend following philosophy, in fact.
Yes, I hate that rule. No one. What is it? You never break the bank when you take a profit. Geez, I hate that rule.
Don't cut losses. Very bad rules. Don't cut losses. Wait until you be in profit. Not cutting losses at all.
That sounds like Druckenmiller. Stop losses are for idiots. Diversification is for losers. That's like Buffett. And then one of the turtle questions that I think Niels asked me a few weeks ago was, you can't go broke taking profits. That's what Richard just mentioned. Can't go broke taking profits.
I hate that.
Can't go rich either.
Okay, I'm going to sign off a couple minutes early of our usual 2-hour fun time together, and I'll leave the room open like I did not do last week. After saying I would, I hit the wrong button. I don't know if anybody has noticed these clips at the bottom, the scissors at the bottom. That seems like maybe something that's kind of fun to use. I took a clip after Richard said something really smart. I did the 30-second clip. I'll see how it worked out. But anyways, thanks to everybody for being here. And I had a really good time as usual. And Richard, thank you for your recordings. And hopefully you got Derek's yesterday. I want to go back and listen to that as well. But
Yeah, I
everybody have a
got
good
that. I
weekend.
got that, Jerry, and I got tonight's as well. So all good.
Thanks very much. Everybody have a good weekend.
Thanks, Jerry. Thanks, everyone. Goodbye.
Bye,
Bye,
everyone.
guys.
Bye.